If you've ever felt like trading is just pure chaos, constantly reacting to news and noise, well, you're definitely not alone. But what if you could swap all that chaos for a clear, professional system? Today, we're going to break down a time-tested blueprint for market timing that helps you move from guesswork to real strategic clarity.
So before we can build a better system, we first have to figure out what's broken. For most traders, the experience is like trying to fly a plane completely blind, totally lost in a dense fog of information overload and, let's be honest, emotional impulses.
The million-dollar question, right? The statistics on this are pretty brutal. And while there are a lot of reasons, a huge piece of the puzzle isn't about some complex market dynamic, but it's actually about the trader's own behavior.
And there it is. It's not about finding some magic indicator. It's about stopping the self-sabotage. It's that constant need to do something, to trade more, to tweak your positions, to react to every little up and down tick. That is just a massive performance killer.
Do any of these sound familiar? Maybe you're glued to the screen, watching every single price change. Or maybe you're chasing headlines you saw on social media. This is exactly what trading in the fog looks like. It's a vicious cycle, really, driven by boredom and the fear of missing out, and it just slowly bleeds an account dry. But there is a way to clear that fog, and it all starts with having a map of the market's terrain.
See, here's the key. Market movement isn't totally random. There's actually a map, a predictable life cycle that assets tend to follow, and learning how to read it is the absolute foundation of professional timing.
This whole concept, which was made famous by a guy named Stan Weinstein, is called stage analysis. And what it shows is that every stock, every index, pretty much every asset moves through 4 distinct and recurring phases. Recognizing which stage an asset is in, that's the first and most critical step.
Okay, so stage 1 is kind of the quiet after the storm. The price has stopped falling and it's just sort of drifting sideways. You can think of it like a coiled spring. Underneath all that quiet, the smart money is slowly and quietly building their positions. For us, the risk here isn't so much losing money, it's opportunity cost, tying up our capital in something that's going nowhere, at least not yet. Now, stage 2, this is where the action is. This is the markup phase, that powerful uptrend we're all looking for. The stock breaks out, the moving average starts pointing sharply higher, and this is important, is the only stage where we should be looking to buy. This is our golden zone.
Then in stage 3, the party starts to wind down. The big advance slows, and the price action gets all choppy and volatile. So why does that happen? Well, because the same smart money that was buying way back in stage 1 is now quietly selling their shares to an excited public. The risk here flips dramatically from opportunity cost to very, very real capital loss.
And finally, we have stage 4. This is when the floor just gives away, and the stock enters a clear downtrend. This is, without a doubt, the most dangerous phase for anyone betting on the stock to go up. As Stan Weinstein famously warned, a stock that looks cheap can always get a whole lot cheaper.
So, if we have established that our only job is to buy during stage 2, that has some really profound implications for how we spend our time and our energy. The secret to professional discipline, it turns out, is actually inactivity.
Take a good look at this number, 75%. I want you to let that sink in for a second, because this figure is absolutely crucial. It represents a complete shift in mindset from amateur impulse to professional patience.
And this is the core principle that really separates the pros from everyone else. The goal isn't to be active all the time. The goal is to deliberately avoid the low probability environments of stages 1, 3, and 4, which, by the way, make up the vast majority of the market cycle. The idea is to trade less to make more.
This slide really shows the entire game plan. Our job is simple. We wait. We avoid the big losses of stage 4, we avoid the choppy, unpredictable mess of stage 3, and we avoid the dead money of stage 1. We only act when we get the green light, when stage 2 gives us the highest probability of success.
Now, identifying a stage 2 breakout isn't just a gut feeling. It's a systematic process. It's a checklist that has to be satisfied before a single dollar is put at risk. So let's walk through that checklist right now.
Okay, first things first. We never ever fight the overall market. You can find the best-looking stock in the world, but if the broader market is in a stage 4 decline, you're basically just trying to swim upstream against a powerful current. We only look for long positions when the major indexes are also in a healthy stage 2.
Next, we need a leader. It's not enough for a stock to just be rising with the market. We need it to be outperforming the market. An upward trending relative strength line is our proof. It's what tells us that institutional capital, the big money, is flowing into this specific stock, making it stronger than all its peers.
You know, price can sometimes be faked, but massive volume? Well, that's the truth. A huge surge in volume as a stock breaks out of that stage 1 base is like finding the footprint of institutional buying. It's the ultimate confirmation that the big money is behind the move. Without it, the breakout is suspicious.
So what's really cool about this slide is how it brings all of these conditions together into one place. This isn't a list of suggestions, it is a strict mechanical checklist. Is the market in stage 2? Check. Sector in stage 2? Check. Is the stock showing leadership relative strength? Check. Do we have that high volume breakout? Check. See? It transforms the decision from an emotional guess into a logical confirmation.
Okay, theory is great and all, but let's make this real. How does this systematic, top-down approach actually look when you apply it to a real trade?
Let's take a look at NVIDIA. Back in early 2023, the NASDAQ index broke into stage 2. That was our big green light for the overall market. Then we saw the whole semiconductor sector also breaking out into stage 2. And finally, inside that leading sector, NVIDIA showed exceptional relative strength, and then it triggered its entry with a massive surge in volume. You see? Market, sector, stock, everything was aligned.
So really, the crucial point is this 5-step blueprint. This is the entire system. You filter the market, you select for leadership, you wait for that disciplined entry signal, you manage your risk mathematically, and you have a clear plan to get out. This is how trading becomes a profession instead of just a gamble.
And that quote really sums it all up, doesn't it? The goal is to stop the constant impulsive clicking and replace it with patient, precise execution. The market doesn't reward frantic activity. It rewards waiting patiently for that perfect pitch and then swinging with real conviction.
And that's the question I want to leave you with. By having a clear blueprint, like the one we've just walked through, you can answer that question with confidence every single time you put your capital at risk. It gives you a plan to trade with clarity, with discipline, and with conviction.